Now, when it comes to investing in stocks, it is important to decide on what basis the stock selection is being made and the objective for investing in those stocks. It should be decided whether it's got for long term or short term, and accordingly the decision is made to look at the business, the company profile, the management. In case of long term, market behavior is considered, and in case of short term, trading pattern is considered. Based on above types of investment horizon, as in long term, stock selection is made based on fundamental analysis. Mr. Warren Buffett says never invest in any business you can't understand and beware of keep pairing formulas. So let's get what is fundamental analysis. This involves analyzing the financial statements, which include balance sheet, P&L statement of business, its competitors and market condition. It focuses on overall state of economy and considers factors including interest rates, production, earnings, employment, GDP and other major factors. Hence, fundamental analysis is performed on historical financial data, but the goal of making financial forecast. Now, there are few objectives of fundamental research. First is to make projection on business performance. The second is evaluate management and decision making skills. The third is calculate the credit risk, basically how much you can trust the company. And the fourth, it is finding the intrinsic value of share, technically how much it's actually worth. Now, there are two different fundamental analysis types, which is qualitative and quantitative. Fundamental analysis talks that involves brand value, the financial performance of company, management decisions and other similar factors can be termed as qualitative approach. The quantitative approach includes numbers. It analyzes the numbers in financial statements and draws a conclusion about the price of shares. The approach is different. Both are equally important in complete financial analysis of a share price. Apart from these two, there are two different processes of fundamental analysis. One is the top-down and other is the bottom-up approach. So understanding number one, which is top-down analysis. An investor starts his wealth with A. Global economies including international and national economic indicators such as GDP, growth rates, inflation, interest rates, exchange rates, productivity and energy prices. B. It is narrowing the industry, looking at factors such as the sales, price levels, competition and other factors. And then only you can find the best business possible. Speaking about second, which is bottom-up analysis. In this, an investor starts his analysis with specific business regardless of their industry or region and proceeds in reverse of top-down approach. When we are doing fundamental analysis to find out an investment opportunity, we have to follow these steps. Number one, which is economic analysis, which is evaluating overall economic situation as the economy consists of different industries and individual companies. Now, when the economy expands, it's quite clear that the industry and economies also tend to grow with it and vice versa when contraction happens. Number two, which is industry analysis. In this, if the result of economic analysis is showing expansion, then certain industries are likely to benefit in comparison to others, as an economy performance is average of all industries. In this, an investor can narrow down the field to those industries that are going to benefit from the current or future economic environment. If the economy is contracting, the investors can seek out stable income-oriented companies. While the company is still important, its industry exerts a lot of influence on the stock price when the stock moves. They usually move as group representing the industry expansion or contraction. It plays a lot to select the right industry rather than selecting the right stock. Once the industry is chosen, an investor would need to narrow the list of companies from the industry selected to go ahead with detailed analysis, which is looking at the business plan, that is understanding business model, the way management visions its future. Here, trying to understand a business plan is important because investors invest in company depending upon the future potential of what it does. If they feel that the management is not motivated enough about the future of company, then the company performance in future might not be good. And then starting off with tools such as earnings. You should consider a wide range of data, but the first point you could look is for the company earnings. Earnings are profits. That figure is the simplest way to get to the point of key investing question: how much money is the company making and how much is it to likely make in the future. They can be complicated to calculate, but that's what buying a company is all about. Lucky for investors, companies report their earnings each quarter. When a company reports their earnings that are on rise, that often leads to higher stock price. In some cases, it also leads to larger dividends or even the introduction of dividend if one doesn't already exist. When earnings fall short of expectations, the market can hammer the stock That means traders quickly sell off their stocks because they seem to be overvalued, causing the price to drop. So fundamental analysis can be referred to as the most in-depth research analysis technique for investment purpose. It helps in finding the true value of a share. Though it is time taking, it helps in predicting the future price of shares using the financial information of company. Now if you got to learn about fundamental analysis, hit the subscribe button and smash the like button. Also do check out this video on how 5,000 rupees of investment can grow to crores. Until then, my name is Vishal. Thank you for watching. I'll catch you in the next.